the real estate versus stock scenario. So I keep talking about stock market versus real estate. I just wanted to provide you two examples of why I believe personally, again, plenty of strengths if you're in the trade, real estate, professional people, really high income, like $500,000, $1 million a year. Maybe you want to stick to the stock market. It's easier for you to manage while you're working with your busy schedule. But if you're like a blue collar sort of a guy, I just wanted to explain to you the advantages of real estate over the stock market. Now, there's a couple of assumptions here I'm making. Now, I've got two people here. We've got the real estate on the left and the stock market on the right. And basically, we're starting with a purchase price of $500,000 in real estate. Now, that's going to be high or low depending on where you are. I'm trying to use round numbers just to make things easy for the real estate side of things because the calculations are a little harder to do. Now, both people, however they've got it, they have $50,000. You'll also see down the bottom there, I've left out the first home buyer's grant as that won't apply to anyone. I'm just using a 10% deposit, $50,000 on a $500,000 property, leaving you an approximate $450,000 balance. So I just want to compare the two scenarios. So scenario A with Sam, in a liquid sense, real estate isn't a liquid or semi-liquid asset. That is, if you have to get rid of it, there's a little bit more effort involved because a lot of documents have to get signed, finance has to get approved. It's a harder transaction to do, but it's, as you'll see at the bottom, it's a much more worthwhile venture. Versus Steve, who is entirely liquid, 50K, getting his assumed net percent return, which you can track back going forever. And getting that 8% return on that 50K. Now, I've calculated, actually I did this video a second time because I left off 1 year for Steve, so I had to re-record the video, and I also didn't calculate the principal pay down on the real estate, so I had to make an adjustment. This is actually the second time I've recorded this video. The outcome's not a whole lot different, but it does illustrate, at least I'm trying to get this information as close as possible to reality of what I think will happen. So stock market, nice and easy, $50,000, 8% net return, going for 10 years. His balance ends up at $106,093. Now that's a straight $50,000 investment, no more investments. That's 8% return per year on that investment. Now there's other ways you can improve that, but there's also other ways you can improve the real estate which give you significantly higher returns than the ways you can do it in the stock market. So I'm just going to leave that out because the numbers then get very complicated. So let's assume 50,000 in both scenarios, and the market is going to do what the market's going to do. So the assumed cost basis for this house for Sam is $500,000. He's putting $50,000 in. He has a loan balance on a 30-year loan, which is variable, of $450,000. Now, I've worked this out at 4%. So I've actually worked, that's actually a couple of percentage points higher than a lot of loans are going through at the moment. So I've calculated this fairly conservatively to give you a realistic outlook on what this is going to do. So again, starting again, both people have $50,000, okay? Sam, the first person with the $50,000, is controlling a $500,000 asset. Okay, he has a 10% equity position. It's $450,000. After 10 years is paid down on the mortgage, a lot of that will be interest. His balance will be roughly $372,000. Now I worked that out here. I got to about there, and I figured that was around the 10-year period. So this is the mortgage choice. It's basically an amortization calculator, which is a fancy way of saying how the interest is calculated on your loan. So you can see here, obviously, that the longer the loan is, the more principal you're paying down. This blue bit's all interest, but you really got to ignore that, particularly if it's a rental property, because you're not really paying that expense. I mean, you're paying it, but your tenant is paying it. So we'll go back to this anyway. So anyway, he's got a $450,000 loan. After 10 years, his principal and interest pay down, he's back to $372,000. Now, he has stamp duty, he has LMI, which is Lender's Mortgage Insurance, which is capitalised to the loan. I've got the figure here, it's actually 11,785. So this original number would be 511,000 approximately. I'm going to leave it at 500 just to make it simple. You'll see at the end why that extra 10,000 won't really matter, but I just left it at 500 just to make it nice and simple for you to understand. I'm just showing I am putting the costs in. So the total out of pocket for the real estate transaction is approximately $65,000. So that is Sam's out of pocket expense is $65,000 he has put into this deal. Let's assume he rents it out, and then he's basically not responsible for any of these costs going forward. The tenant pays for that. Now that's another video. I'll do another video on that. Whereas Steve, 50,000, 8% return on his index funds over a 10-year period, 50K invested. I'm using the same 10-year period. Real estate is recommended you stay in it for 10 years. Any 10-year period, it's generally accepted you will make money. Obviously, the better you get at it, you'll be able to time it, you'll be able to do better. But I'm trying to use the same example for both things. So basically, his out of cost expense is $65,321. Now, I'm going to assume a $500,000 property going to $1 million in value is I'm hopeful that that is not too much for you to understand. This sort of thing in real estate, 500 to a million, or 250 to 500, or 300 to 600, that is a regular thing in real estate. That is almost normal. It's so regular. So while the number might seem silly now, depending on where the area is, I can tell you this is a very realistic scenario I'm putting up here. Now, the other thing I'm not putting in, which is a much more difficult calculation, is the internal rate of return of the real estate. So what the IRR, or the internal rate of return, that is accounting for your depreciation, your tax benefits, all your repairs, your renovations, increases to capital value, which is equity. That's quite a complicated calculation. It's almost way too much to get into this video. Now, there are things like this you can do over here as well, but they don't give you the same advantages in the real estate market. So 90% of the world's long-term wealth is in real estate for a reason. The reason is the tax advantages mostly, even if you're positive gearing. Like this property, the scenario, if it's not already positive to neutral gearing, it's going to be positively geared very, very quickly. So again, I'm assuming a 4% interest rate on this for this amortization schedule here. This is using, you can see I'm using a 4% rate. So now we're getting rates around the 2. But I'm just showing you what people don't realize is people think they buy a $500,000 property and it goes to $1 million, and they go, oh, well, I made $500,000. Well, yeah, you did, but the way you think you made it is not the way you made it. Your cost basis was $65,321. So assuming the holding costs are paid by tenants, the tenants are paying the holding costs on these properties. So your out-of-pocket expenses are $65,321. And let's assume future value, I'm using round numbers, $1 million. So your actual out-of-pocket expenses are $63,321, giving you a $628,000 total return on your real estate, given the cost basis and the principal pay down. So the 450 less the 72, so we're looking at $372,000 of equity minus the million, so million less 372. Then we're adding back the 63 that went in, and then we're getting what is it? Bottom line, your actual profit is $565,000 on the 63K outlay. So your outlay, if you to assume it's a rented property, the tenants are paying those costs. Now, I'll do a whole another video on why those costs are the tenant's costs. They're not your costs. Even though you hold the debt, the tenant is actually paying those costs. So the $63,000 is what you outlay. Your profit is $565,000 after 10 years, assuming $1 million future value, which is not unrealistic. Your actual return multiple is based on this $63,000, not the 500, not the 450, not the 372. Your initial, what you spent to set up this asset was $65,321. So your multiple, your return multiple on that money in 10 years is 9 times multiple. So 9 times 63 gives you roughly $565,000 profit. So, or if you go over here and you're doing the stock market thing, 50,000, 8% of your net return, you're getting you're getting $106,000 approximately over 10 years. Sorry, that actual profit figure is wrong. It's 56,093. So you're ending up with $100,000. This guy's ending up with $500,000 over the same period using roughly the same as close as I can get them. So for a lot of people, the 500 to a million will be hard to understand. People think that's hard to do. That's pretty normal. It's more to do with how money's diluted. We could get into the whole Federal Reserve thing, all that sort of thing. It's to do with the dilution of currency and how currency is circulating. I've just got a picture off a mate. There's a Bunnings store in Melbourne, and they have no 70 by 35, 90 by 45. They have no timber. It is bare. There is no timber. I'm building a house myself. I'm having to wait till August for a frame, just the frame. And I was told a 12-week wait. Now it's to August. That's way longer than 12 weeks. And I started this process back in October. When that building grant came out, I jumped on it. As I say, when these grants come out, jump on them. Quickly, you'll do well. If you wait, you then won't do as well. You'll still do okay, but you won't do as well. Anyway, bottom line, there is no timber, which means there's going to be more of a shortage of stock, which means there's going to be more upward momentum in prices of existing stock because people physically cannot build houses quick enough to supply the market with enough rental properties. So you're going to have upward pressure on rents and you're going to have upward pressure on capital values. So these numbers, if we go into a big to high hyperinflation, this $1 million could be a very low number. We could be talking $5–10 million. And now that sounds ridiculous. It sounds ridiculous, but the spending that we've done through COVID is wartime level stimulus. You have to understand that the baby boomers, people call them boomers, and they all these, I really don't care, they got all these names for boomers. The reason the boomers did so well is the stimulus coming out of World War II, and they put it in real estate and they held it for a long time, very conservatively, very tax efficient, and they made a lot of money. And you shouldn't be resenting these people for that. They did well, good for them. Don't worry about what they did. I'm telling you what you can do right now. You can put $50,000 into a property. You can control a $500,000 property and watch that go to, I'm going to say on the low end, $1 million, and you can make $500,000 with every single deal you do, or a 9 times multiple of that original $63,000, or a 2 times multiple. Make good choices. If you're a professional, you're a doctor, dentist, lawyer, anything like that, this is probably going to be more you because there's less time. You set an amount, a fixed amount, you just keep investing it, and the returns will actually be better than this. But there's things I can show you on the real estate side that will kill whatever you're going to do over here anyway. So the point is, I just wanted to show you how to actually calculate the return on real estate. It's not the cost basis to the final value. It's actually the out-of-pocket expense less the debt, less the equity. So we're looking at a $65,000 outlay returning a $565,000 amount of money, which is a 9 times multiple. So I just wanted to give you that example of how you actually work out the returns on real estate going forward. Now we're only just at the start of the second part of this cycle. It's actually an 18.6 year real estate cycle. We're at the very, very start even now of the second half of that cycle. So this is going to continue on, these double-digit growth, this is going to continue on for some time. Now people might not like hearing that. I've been saying that on YouTube for some time now. I've been copying a lot of shit, particularly Mike Martin's Mike in the Night. I'm going to start doing Wes in the Day because I've said this to him for 2 years and he's had the back right off because even his subscribers are like, no, you were right, I don't want to hang shit on that guy, but I have said to him, I would like to interview this guy now and go over what's actually happened now versus all these doom and gloom, merchants of doom on the internet that, in all honesty, has cost people potentially their entire financial future. So I'm open to having a discussion with Mike. I think he's a nice enough guy, but at the same time, it's cost people a lot of money. Listening to these merchants of doom has cost people a lot of money. There's only a handful of people in those YouTube comment sections that actually are in the real estate game, they're actually in the money game, and they actually understand what the fuck they're talking about. Other thing as well, I just wanted to say the difference between liquidity and illiquid or liquid. When I'm saying cash in the bank down here, liquidity, I just saw this, I thought I'd put a note there. Cash in the bank is liquidity. You have liquidity, cash in the bank. Same as a stock portfolio, it is liquidity. Real estate is generally considered an illiquid or semi-illiquid asset, even if it's owned freehold, unless you're prepared to burn it for half price, which I wouldn't recommend you sell any real estate at the moment with what I'm seeing coming through. Anyway, a bit of a long-winded video there. I'm hoping you can see the 9 times multiple versus the 2 times multiple over the same 10-year period. I've tried to do an apples for apples comparison there. And anyway, do with that what you like. Give it a thumbs up and a subscribe. I would appreciate it. And thanks, and I'll see you next time.